Critical Man Pictures presents the Forex video training series. Red Belt, Introduction to Breakouts. When trading breakouts, the goal is to ride the momentum until volatility dies down. Notice I didn't say volume, I said volatility. Unlike trading stocks or futures, in Forex there is no way to see the volume of trades made in the Forex market. With stock or futures trade, volume is essential for making good breakout trades. So not having this data available leaves Forex at a disadvantage. Because of this disadvantage, we have to rely not only on good risk management, but also on certain criteria in order to position ourselves for good potential breakout. If there is a large price movement within a short amount of time, then the volatility would be considered high. On the other hand, if there is relatively little movement in a short period of time, then volatility would be considered low. While it's tempting to get into the market when you see a faster moving than a speeding bullet, you'll often find yourself more stressed and anxious, making bad decisions as your money goes in and then goes right back out. This high volatility is what attracts a lot of traders, but it's the same volatility that kills a lot of them as well. The goal here is to use the volatility to your advantage. Rather than following the herd and try to jump in when the market is super volatile, it would be better to look at currency pairs with volatility that is very low. This way, you can position yourself and be ready when a breakout occurs and volatility flies onto the roof. Volatility is something that we can use when looking for good breakout trade opportunities. Volatility measures the overall price fluctuations over a certain time, and this information can be used to detect potential breakouts. There are a few indicators that can help you gauge a pair's current volatility. Using these indicators can help you tremendously when looking for breakout opportunities. Moving averages are probably the most common indicator used by traders, and although it's a simple to, provides the most data. Simply put, moving averages measure the average movement of the market for an X amount of time, where X is whatever you want it to be. For example, if you applied a 20 SMA to a daily chart, it would show you the average movement for the past 20 days. There are other types of moving averages, such as exponential and weighted, but for the purpose of this lesson, we won't go into too much detail on them. Bollinger Bands are excellent tools for measuring volatility because that is exactly what it was designed to do. Bollinger Bands are basically two lines that are plotted 2 standard deviations above and below a moving average for X amount of time, where X is whatever you want it to be. So if we set it at 20, we would have a 20 SMA and 2 other lines. One line would be plotted plus 2 standard deviations above it, and the other would be minus 2 standard deviations below. When the bands contract, it tells us that volatility is very low. When the bands widen, it tells us that volatility is very high. The last on the list is Average True Range, or ATR. The ATR is an excellent tool for measuring volatility because it tells us the average trading range of the market for X amount of time, where X is whatever you want it to be. So if you set ATR to 20 on a daily chart, it would show you the average trading range for the past 20 days.